John D. Rockefeller did not become the richest investor by luck, intelligence alone, or innovation alone. He became the richest investor in history by mastering structure, control, cost discipline, and capital compounding before the modern financial system even existed. At peak, Rockefeller controlled approximately 90% of U.S. oil refining capacity. Adjusted for inflation, his wealth exceeded $400 billion, making him the wealthiest individual in recorded history. This is not a motivational story. This is a capital blueprint. What follows is the exact journey, and the exact principles, that created the greatest concentration of investment power the world has ever seen. Rockefeller's foundation was not oil. It was accounting discipline. At age 16, Rockefeller worked as a bookkeeper. Every dollar was recorded. Every cost was tracked. Every margin was analyzed. This behavior was not temporary. Rockefeller maintained detailed personal ledgers for his entire life. Before capital is multiplied, it is controlled. Before empires are built, leakage is eliminated. Most participants chase returns. Rockefeller engineered cost certainty. Rockefeller entered oil in the 1860s, not because oil was fashionable, but because demand was structurally guaranteed. Kerosene powered lighting across industrializing America. Railroads required fuel. Cities required illumination. Rockefeller did not speculate on discovery. He invested in refining, the choke point between extraction and consumption. This decision converted volatility into predictable cash flow. Power is built where others must pass through. Rockefeller's advantage was not monopoly first. It was cost supremacy. Standard Oil reduced refining costs relentlessly. Negotiated secret railroad rebates. Built proprietary barrel manufacturing. Acquired pipeline and storage infrastructure. Eliminated waste at every production layer. Competitors failed not because Rockefeller attacked them, but because they could not survive at his cost level. Markets do not reward fairness. Markets reward efficiency at scale. Standard Oil was not merely a company. It was a system. By the 1880s, Standard Oil controlled refining, transportation, storage, and pricing. This vertical integration removed external dependence. Risk was internalized. Margins were stabilized. Competitors were structurally irrelevant. True dominance is not size. It is control over the entire value chain. Rockefeller did not extract wealth. He recycled capital. Profits were reinvested into infrastructure expansion, market consolidation, cost reduction technology. Compounding occurred not through risk, but through reinforcement of advantage. Wealth grows fastest when capital strengthens its own moat. In 1911, Standard Oil was broken up by U.S. antitrust law. This did not destroy Rockefeller's wealth. It multiplied it. Rockefeller retained ownership stakes in all successor companies, including Exxon, Mobil, Chevron predecessors. Structural ownership survived regulatory force. True investors adapt without losing control. John D. Rockefeller followed immutable laws. Control costs before chasing growth. Own infrastructure, not speculation. Dominate choke points. Reinvest relentlessly. Maintain ownership through disruption. This is not history. This is how capital still concentrates today. Top profit investors do not predict the future. They structure it.